In October of 1973, the price of oil quadrupled almost overnight. Gas stations ran dry. Cars wrapped around the block for hours. And the stock market? It lost nearly half its value. But while millions panicked, one investor was quietly getting rich. I've watched markets for 50 years. And if there's one crisis that teaches everything you need to know about investing, it's this one. The oil embargo of 1973 wasn't just an energy story. It was a fear story. It showed how quickly the crowd loses its head and how the patient few profit from that panic. Stick with me, because the third lesson here is the one almost every investor still gets wrong today. It started with a war. On October 6, 1973, conflict broke out in the Middle East. Days later, the Arab oil-producing nations, OPEC, did something no one expected. They cut off oil exports to the United States. The effect was instant. A barrel of oil that cost around $3 in early 1973 shot up to nearly $12 by early 1974. That's a fourfold jump in months. And America wasn't ready. The country imported a third of its oil. Suddenly there wasn't enough. Gas stations posted "sorry, no gas" signs. States introduced odd-even rationing, you could only fill up based on your license plate number. The speed limit dropped to 55 to save fuel. This wasn't a slow decline. It was a slap in the face. And Wall Street felt every bit of it. But here's where it gets really interesting. The stock market didn't just dip. It collapsed. The Dow Jones peaked at 1,051 in January of 1973. By December of 1974, it had crashed to around 577. That's a drop of roughly 45%. Think about that. Nearly half of everyone's wealth gone. The broad market, the S&P 500, fell about 48% from top to bottom. It was the worst bear market since the Great Depression. And it got worse. Inflation roared. Prices climbed while the economy shrank. Economists invented a new word for it, stagflation. Stagnant growth, rising prices. The textbooks said that couldn't happen. It happened anyway. The darlings of the era, the so-called Nifty 50, blue-chip stocks everyone couldn't lose on, got demolished. Some fell 70, 80%. The crowd had paid any price for safety. And safety, it turned out, had a price too. So what did the smart money do? That's the part most people never hear about. While the world panicked, Warren Buffett was grinning. In 1974, deep in the carnage, Forbes magazine asked him how he felt about the market. His answer? He said he felt like an oversexed guy in a harem. His point, there were beautiful bargains everywhere, and he could buy whichever he liked. He wasn't joking. In 1973, as fear gripped Wall Street, Buffett invested about $10.6 million into a single company, the Washington Post. Everyone else saw chaos. He saw a wonderful business trading for a fraction of its real worth. That stake eventually grew to be worth well over $1 billion. Buffett understood something the crowd forgot. A falling price doesn't mean a falling business. The Washington Post still printed newspapers. People still read them. The company's value hadn't crashed, only its stock price had. And price is not value. This is the lesson most investors still get wrong. They sell when prices fall, locking in their losses. They buy when prices soar, paying for the privilege. They do the exact opposite of what works. Here's the truth 50 years later. The oil embargo officially ended in March of 1974. The gas lines disappeared. And the market? It recovered. By the early 1980s it was climbing to new highs, the start of one of the greatest bull runs in history. The investors who sold at the bottom in '74 never recovered those gains. The ones who held, or better yet, bought, were rewarded handsomely. So the real enemy was never the oil. It was fear. Fear made people sell wonderful businesses at terrible prices. Fear convinced them the world was ending, when really, it was just rearranging. Every crisis since has followed the same pattern. 87, 2000, 2008, 2020. The headlines change. The fear is identical. And every single time, patience won. Here's what 1973 taught me, and what I want you to remember forever. The market doesn't punish the bold. It punishes the panicked. When everyone is running for the exits, that's exactly when the real bargains appear. As Buffett put it, be fearful when others are greedy, and greedy when others are fearful. The oil crisis didn't destroy wealth. Fear did. And fear is a choice. So let me ask you, have you ever sold an investment out of fear, only to watch it climb right back? Tell me your story in the comments. I read every one. And if this changed how you think about market crashes, hit subscribe. We make one video every day to help you invest wiser. Tomorrow, we're looking at a bubble that fooled even the smartest investors in the world. You won't want to miss it. Remember, this is educational content, not financial advice. Always do your own research. Past performance never guarantees future results.